John just turned 50 years old and has a saving of $200,000 in his bank account. He thinks it's about time for him to start looking at investing the money for his retirement planning. His financial advisor conducted a risk tolerance assessment, and it falls into the moderate to aggressive category. Since John wants to retire at the age of 60, which gives him 10 years, his financial advisor proposed several options for him to consider. In the end, John decided to allocate half of the money that he saves in the bank to a 10-year tax-deferred annuity product. The product also comes with guaranteed lifetime income rider to guarantee a certain percentage of his retirement income at the age of 60 until the day that he passes away. Hi everyone, thank you for watching this episode of How Our Money Gets Taxed series in our Financial Foundation segment. This is Zita. In this episode, we will talk about the third bucket of how our income gets taxed, the tax-deferred bucket. What is tax-deferred? It refers to the fact that any earnings of your money that you put in this type of account, such as, but not limited to, your investment interest, dividends, and capital gains, etc., wouldn't be taxed until you take them out. Depending on the source of the money that you put in, there are mainly two types of tax-deferred accounts. First one, qualified tax-deferred account, and second, non-qualified tax-deferred account. For the qualified tax-deferred account, as I mentioned in our previous episode, explaining the tax-qualified bucket, the money that you put in those qualified accounts, such as 401k, traditional IRA, and SIP IRA, etc., are tax-deductible and can reduce your taxable income of the year. At the same time, the growth of your money in those accounts are also tax-free every year, and you wouldn't need to pay taxes of the money in these qualified plans until you take the money out. These qualified accounts, though, all have a limited annual contribution amount. The tax-deferred annuity account that John decides to open in the example that I just mentioned in this episode is categorized as a non-qualified tax-deferred account. The account is funded by John's after-tax income that he saved in his bank account, and they do not reduce his taxable income of that year. However, the money will grow tax-free in the account, and when John takes the money out in the future, only the earnings will be taxable, but not the principal amount that he contributed into the account. Tax-deferred account is a very powerful way of growing your money, and I will explain that in details in our following episode. Thank you for watching, and please stay tuned. See you all later.
We are Chains Explained, your one-stop shop for blockchain and financial education.